Although the bulk of the GOP's tax overhaul legislation isn't scheduled to kick in until January 1st, financial giants like Goldman Sachs are already reporting earnings losses as they adjust their assets and operations to fall in line with the new laws of the land. In a filing to the Securities and Exchange Commission on Friday, Goldman reported the new tax legislation will result in a reduction of approximately $5 billion in the firm's earnings for the fourth quarter and year ending December 31, 2017. Goldman won't officially report its fourth quarter earnings until mid-January, but the company warned investors on Friday that the one-time tax costs could mean its first quarterly loss since 2011. About two-thirds of the expected losses are related to a new one-time repatriation tax on overseas earnings. The remainder of the charges stem from the U.S. shifting to a more territorial tax system and from Goldman Sachs revaluing some of its deferred tax assets. Among the tweaks and alterations in store for U.S. companies is a one-time 15.5% tax on cash and liquid assets and an 8% tax on the liquid assets currently held overseas. Those rates are lower than both the former corporate rate of 35% and the new 21% benchmark that will go into effect in 2018. Under the old tax code, companies were taxed on their foreign earnings at a relatively high rate, but only if those assets were repatriated back to the U.S. As a result, American multinational companies built up trillions of dollars in offshore earnings, essentially deferring their tax obligations indefinitely. For financial institutions like Goldman, which earns roughly 40% of its revenue internationally, the new tax legislation is a double-edged sword. On the one hand, the company will be able to repatriate its substantial international holdings at a much lower tax rate. But on the other, Goldman is now on the hook for several $billion in payments to the IRS. Goldman, at the very least, is in good company. Barclays earlier this week estimated the tax bill would cost the company more than $1.3 billion. Bank of America last week warned its earnings would be cut by $3 billion as a result of the new legislation, while Citigroup estimated earlier this month that it could be out as much as $20 billion in the fourth quarter of 2017. But financial stocks aren't exactly tanking, with Goldman down only about 0.2% in midday trading Friday. That durability is in part the result of high expectations for banking and financial institutions under the GOP's new tax plan. You're going to take certain companies that have tax rates in the low 30s or the high 20s and reduce their tax rate to 20%. That's going to be a benefit, Jared Seaberg, managing director at Cowen Research Group, told Bloomberg in an interview earlier this month. Banks have among the highest effective tax rates, so if you take their rate of around 30 and bring it down to 20, that's pretty good for those companies. Indeed, investors appear to be taking the quarterly losses with a grain of salt. Richard Bove, a research analyst at the Vertical Trading Group, told CNBC in an interview Friday that he thinks the tax reshuffling will encourage financial giants like Goldman to reallocate some of their assets to take advantage of the new laws. He said he wouldn't be surprised if Goldman Sachs pulled forward some of the costs from 2018 into 2017, essentially front-loading losses into a quarter that was already going to suffer from tax complications. This write-down in the tax area is basically going to create the opportunity for them to take many steps in terms of adjusting the balance sheet if they choose to do so, he said.